Question number 1. Yes, Mr. Suni, the CEO of Sheetal Textiles India Limited, is the CEO of Sheetal Textiles India Limited. His basic salary is 6 lakhs per month and he is paid 8% as DA on it. Okay. He contributes 10% of his pay and DA together 10% on this towards RPF, that is a recognized provident fund, and the company contributes also the same amount. Now the accumulated balance in the RPF account as on 3 years. So they're giving you for 3 different years, as on 1/4/2020 and 31/3/2021, 31/3/2022. So it is like end of the last 3 years. This 50 lakhs 35,000, 71 lakhs 46,700 and 94 lakhs 57,700 respectively. This is the accumulated balance for the ending period. Now compute the perquisite value chargeable to tax in the hands of Mr. Sunil under section 17(2)(7) and assessment year 22-23. So perquisite. So it is clearly given it is a perquisite. So perquisite is some benefit given to the employee by the employer, right? Yes. So these are taxable perquisites. So some perquisites are not taxable at all and some are partly taxable, some are fully taxable. So now, how many of you remember this RPF contribution? Up to what amount is it? Is there any limit for exemption or is it fully taxable? So, yeah. What is tax? Yes, yes, Amar.
When there is a limit on employer's contribution of 12%.
Yeah, so you're saying there is a limit.
Exemption.
Yeah, so there is a, I was not on this. Yeah, so there is a limit up to which it is not taxable, right? That's what you told me, right, Amar?
Yes, ma'am.
Yeah, so you remember any amount up to which it is not taxable, and there is also any contribution. And what is taxable is, what is the situation here? The employee is contributing towards RPF fine. On this other hand, the employer is also contributing. So the employer's contribution is a perquisite. Okay. Employee contributes for his own good, but what the employer contributes is a perquisite. So that portion of it is taxable. Okay. So here there is a formula involved to find out the taxable perquisite. So you're going to find out the excess interest, whatever has been given to the employee, which we are going to tax. So computation, the way of presenting the answer, okay, you need to definitely give working notes and you need to definitely give the headings, computation, directly going with the answer. I know you may know everything correctly, but then if you don't present it in a way, you may lose the step marks. So definitely give the heading of perquisite. Okay, section is already given in the question, so it will not be something for you to remember. If you're not very sure, try to remember, otherwise don't give wrong section numbers. So for assessment year 21-22, yes, that's what we are going to find out. Yes. So first one, okay, it went on. Now, how do we calculate the taxable perquisite? Now, what has been contributed by the employer? How much has been contributed by the employer? It has been given in the question. He is earning 6 lakhs per month. So 6 lakhs into 12 is his salary. On that, there is a DA portion. Okay. So just going back to the question, 6 lakhs per month is the basic salary. So into 12, the basic salary for 12 months. Plus, there is a 8% DA on that. So how much do you get? Yes. So 6 lakhs, anything? Or shall I open a worksheet? I shall open a worksheet. Okay, so it is 6 lakhs per month salary. Per month, 6 lakhs basic. I mean, I hope you're all very good in this, so I don't have to actually do this. So into 12, then there is a DA contribution to it. So this into 8% DA. And the contribution that goes towards this recognized fund is 10%. Okay, so the RPF contribution on this is 10%. Employer contributes, okay, then there is an employee contributes, okay. Since there is an employer contribution, we need to tax it. So this is the contribution made by the employer, 776,777,600. Okay. So yes, so back to the question. So we have found out 777,600 being the employer's contribution to RPF during the year. But the provision says anything above 7,50,000 will have to be taxed. Okay, so the perquisite value taxable under section 17 to subclause 7 is 27,600. Keep this here. Now we need to find out under 7 subclause 8. So that is whatever has been annually accruing, the interest. They may pay interest, they may pay dividend. So other incomes that get annually accrued. So there comes a formula. Okay, so under this we have this formula. Okay, so if you know the abbreviations, if you know what this stands for, very good. If not, we will see them in detail. So you can note down this if you don't know. Otherwise, the formula is PC bar 2 into R plus PC1 plus TP1 in the whole thing into R. So what is all this? PC, R, and so on. So what is PC? What he has contributed, what the employer has contributed in excess of 7,50,000. So here yearly the employer is making a contribution, right, which is 10% of his pay plus DA. So that which is exceeding 7,50,000, up to 7,50,000, if it has been no issue. Since it exceeds that, this PC is that excess amount in excess of 7,50,000 to this RPF. Now, what is PC1? Any idea what is PC1? If you remember, anybody remembers? It's nil in the case, the problem is given, but then it is the amount. Okay, PC is the amount employer's contribution, which is in excess of 7,50,000 in the previous year, in 1 year, in the previous year for which we are doing. PC1 is that same excess, which is same amount, which is in excess of 7,50,000 for previous years, other than the current previous year. So since we are doing for 2022, 21-22, other than the previous year, any other accumulation in the RPF balance other than the current previous year. Okay, so such thing is actually not given in the question. How much has the PC1 been? We are not aware of, and we assume it is not more than 7,50,000 because we are going to work out here. So see here, PC1 and TP1 are nil. In the sense, in the year, other than the previous year, it has not exceeded 7,50,000 in case of PC1. Okay, and R on the other hand, there is a formula, I divided by, you'll have to use this formula. But what is I? What is F average? I is purely income which has accrued in this RPF account. Okay, any income which has accrued in the RPF account during the current previous year. So if there has been any interest, if there has been any dividend, it will all get accumulated here. So I don't know how much, but we know an information they have given the respective closing balance in the RPF account for 3 different years, right? So 71 is the latest. I go to the question. So the 71 is the latest closing balance. Is the for the 31/3/2021 for which you are doing is the closing balance. Okay. So from there we work out this. The 71 closing of 31/30/2021, and then 2 people contributing to it. Employee and employer has contributed in that year so much. minus the previous closing balance, the previous year ending or the beginning of the year, the closing balance. So here you will get what has been the income portion accrued in this investment. So I get about 5,50,000 when I subtract these amounts from the closing balance of 21. So this has been the income portion. These are what the employer and employee has contributed. Apart from their contribution, there is an extra amount. How is that extra amount? Interest has been accumulated or any other income has accumulated in this particular account. That amount you're finding out to be as 5,56,000. These are all the contribution. Other than that, whatever has accumulated is the income amount divided by account as on beginning of 2020 plus as on what amount has been at the end of 2021. Yes, so 20 beginning and 21 ending. Okay, just the closing opening divided by 2. I get an average, right? So beginning it has been 50 lakhs, ending it has been 71 lakhs, divided by 2, I get an average investment. This is the amount of investment, but it's an average investment. So when I by this average, I get my R, my return is, rate is. This R needs to be used in my formula. So when I substitute all the values, okay, this is 27,600, which you have found here. When I substitute all these values divided by 2 into this R, I get the perquisite value taxable as 1261. Yes? Yes, people? Clear?
Yes, ma'am.
Yeah. So this is the taxable value of perquisite. Now we are doing for one more year. The question doesn't stop with just 1 year, 2021-22. We need to find out the value for 22 and 23. So here also same 10% contribution. There has not been any hike in the salary. So employer contribution holds the same formula. Okay, so step number 1 under this year is clear. Now, step number 2. So here the formula, the value we get. So annual accretion on this investment, which is going to be taxable. We will find out. So here the rate up to this point, the same thing holds good. So we are clear about it. Now we need to substitute for the second part. So here one more year has passed by. So other than the previous year only is this the right hand side of the formula. So PC by 2 into R is for the current previous year. PC1 plus TP1 is for the earlier previous year other than the current previous year. Okay, holds the same. R is the same formula that we had used. And now we need to find out what has been the accumulation in this balance for other previous years after 1/4/2020 to the latest, leaving the current previous year, what has been. So there's been only 1 year after that. 2020 onwards only this taxable perquisite had come. And so 2020-21, 21-22. 2 years we have. In our first part, we did for the current previous year. Now we are finding out for the other one. So yes, so if you can substitute this, you all very well know 27,600. PC1, again, amount of employers' contribution in excess of 7,50,000 in the previous year 2021. It has been the same amount, right? When I did for the last year, that was the first year, so there was nothing already accumulated balance. But now I am doing the computation for the second year. So the already accumulated balance in my previous year is 27,600. And you've also found out your TP1, what you did in your computation 1 for assessment year 2020-21. So taxable perquisite is 1261. Other things holds the same. right? And FAG is the closing balance. They have given you 3 years accumulated balance, right? So 2021 beginning and 2021 ending, divide by 2. The balance is already given in the question. You get the FAG, F average fund, what the average amount in the fund. So that your I interest, whatever has accumulated is the closing balance minus 2 people have contributed so much, employer, employee, minus the opening balance. I get how much has accumulated as interest. So that divided by this, I get 0.0910. This R I use for the right hand side of the formula. Now if I substitute, I get this value. Yes, so this is the perquisite taxable for the second year in the question. Clear, everybody? So up to 7,50,000, actually nothing is taxable. So in anything in excess, you get one part, clause number 7 being this amount. Question number 2. So we saw one problem under salaries. Now we are moving on to next head of income. What is this head of income, people? What head of income is it targeting? Yes, what head of income is this? There's a slump sale. So some slump sale, which chapter does it hit?
Capital gains.
Yeah, very good. So capital gains, the meaning is a long-term investment, okay, or a short-term investment you can make. When there is an investment that you have made, it doesn't really there's no gain part, but when you're selling that investment, so the sale minus whatever cost you have bought, considering the increase indexation benefit, considering all that, the gain or loss is charged to tax. So if it's a gain, it is charged to tax. So that's all about capital gains. So, but here the question we are dealing is with regard to slump sale. So slump okay. So if generally, if I have somebody wants to take over it, and I will assign individual value for all the assets and liabilities. My debtor is worth so much, my asset is worth so much, my liability is worth so much. But then here, without assigning such individual values, I just wholly transfer, buy my business for 1 crore. No individual valuation. The buyer will not individually be bothered about the assets value and liabilities value. That's slump sale. Sale for a lump amount. Okay, remember that way. Don't forget. So this is taxable under section 50B of Capital Gains Income Tax Act. So if there is a gain when you have made a slump sale, that gain is charged to tax. Okay, so it is that your entire business is taken as a whole. No individual valuation done. That's all about slump sale. Yes. So if you have started the business very long period, say 36 months and so if it is nearly 3 years and more, it will be a long-term sale gain. And if it is a short-term, anything less than 36 months, it will be a short-term capital gain. Clear? The concept is clear? Yes. Anybody still not very clear about the concept? No, right? So shall we see the problem? Mr. Aditya, having 2 stores, is a proprietor of Star Stores having 2 units. Okay, there's unit 1 and unit 2 about for his store. So, and on 1/4/2021, he has transferred one such unit, that is unit number 2, which he started when? 2004-5. He has sold his unit 2 for a slump sale, which gave him a total consideration of rupees 18 lakhs. There is a fees, professional fees, auditor, you need to pay for an auditor, you need to, for some consultant, brokerage charges, which he incurred about 78,000. Now the balance sheet, which you see, is as under for the year 31/3/2021. Okay, so 1/4 he sold. The ending period, ending year period, we see the balance sheet below. Yes, so we have assets for the 2 units given separately and total, and liabilities given as one hand. So here we see land, furniture, debtors, patents, unit 1, unit 2. Here liabilities, capital, reserve, some information about bank loans, 70% for unit 1, 20% for unit 2 trade creditors. Unsecured loan is 30% for unit 2. So there is a detail all about given all about for unit 2. Now we are going to see whether he sold this on a gain and whether that gain is a long term or a short term. Now tell me whether this gain is a long term or a short term. With the introduction that I have given, when is it considered as a long term?
More than 1 year.
Oh, a year. No, in case of slum sale, it is more than 36 months.
36 months.
Yeah, correct. So 3 years, that's roughly. So 3 years definite, because when did he start? 2004-5, he started this unit more. So it's a long-term capital gains. Okay. Yes. So now we'll see how do we go about with working this. Yes, people. Generally, in long term, we get the indexation benefit, right? Here, in case of slum sale, we don't get indexation benefit. You all know indexation, right? So they give you the inflation index for the current year, for the year which he bought this into that. We will find out the indexation. Yes, indexation concept is all aware of. Here, in case of slum sale, though it is a long term, generally in long term gains, we do indexation. But in case of slum sale, we cannot take the indexation benefit. Just the sale value and no hiring, increasing the cost to that extent. Okay. Now let's go ahead. So yes, there is some which he's actually selling, was purchased in 2004 at the rate of rupees 5 lakhs, which is again revalued in 31/3 for rupees 7,50,000. No individual value of any asset. Yes, because it is a some slum sale. In the information, if even if it is not given, it is understood. No individual valuation for any asset. Patents, which you saw in the asset side, was acquired on 1/12/2019, but no depreciation has been provided up to now. Okay. Furniture of unit 2 of rupees 5 lakh purchased on 1/12, on which again no depreciation has been provided. Fair market value of the capital asset transferred by way of slum sale is 18,10,000. So at what price is he selling unit 2? 18,10,000. Compute capital gains for assessment year 22-23. Now, as I said, slum sale comes under section 50B of the Income Tax Act, which says profits and gains arising from the slum sale. So you have to give a brief 1 line or 2 lines about slum sale. Okay, then it will create a good impression on your in the minds of the evaluator. So he knows about the slum sale. He knows the provisions with regard to this. So it says 50B if you give the provision, and if you say slum sale, in case of slum sale, the gain arising on transfer by way of slum sale is chargeable to capital gains. And if it is held for more than 36 months, it becomes a long-term capital gain and no indexation benefit can be availed on that. So this detail, you get a good start for your evaluation. Then you go with a problem. Okay, no indexation benefit. Now, yes, now computation of slum sale. Now I know they have transferred the whole unit, no individual valuation to the assets liabilities. So the amount for which I am selling it to the buyer is 18,10,000. Okay. And the full, that is fair market value of the slum sale transferred by way of the slum sale is 18,10,000, or the fair market value of the consideration received, that is 18 lakhs, whichever is higher. So this is the actual problem. But how did I get 18 lakh 10,000? At least this was mentioned in the question. You remember the transferred amount, the fair market value is 18 lakh 10,000. Okay, yes. But now what is not given? This is also given. He transferred the unit at what rate? 18 lakhs. So it's all there in the question. 18 lakhs, he sold the unit for, and 18 lakh 10,000 the fair market value. Comparatively, which one you will use? You will have to compare the FMV with the sale value, the slum sale value. Okay, so which is higher of this? 18 lakh 10,000, the fair market value is higher. So I take that as my full value of consideration, FVC. FMV is different, FVC is different. This is sale value or consideration value, FVC. FMV is the market value or fair market value of that unit. That I will compare with the consideration value, which I received. Higher I take this. Yes, all the professional fees, brokerage, admissible expenses, which can be reduced from this sale value. So this is actually my net value of consideration. So much I got, but I incurred so much of expenses, and this is my net full value of consideration. Now, cost of acquisition, that is what is unknown to us. Okay, so cost of acquisition, there is a formula, after which what you get is your long-term capital gains. However, cost of acquisition doesn't have indexation benefit. By my cost of acquisition has a formula. How many of you remember the formula? Yes, what is my deemed cost of acquisition or cost of improvement? Yes, anybody?
Total value of assets minus external liabilities.
Very good, super, yeah. So it's total value of the assets minus my liabilities, which is nothing but my net worth. That's what we refer here as. So on the net worth, we need to find out through a working note. So this is the main answer to your question. So keep this as the beginning. Here down, you can do your working notes, or you can start with your working notes and then go to the problem. Maybe if you're not sure of how much space should I leave. So you can do it anyways, but follow the order. Don't working notes in the middle and again, main problem. Don't confuse the evaluator. Now keep this as a question mark. Let's see how do we find out the cost of acquisition. As your friend rightly pointed out, it is the assets minus the external liabilities. Assets minus liabilities, when I say, not just purely taking from the balance sheet. And the assets, has certain information has been given to me with regard to those assets and liabilities. Now, our concentration is not on the entire balance sheet of this company. It is only with regard to unit 2. So what were there in the asset side, and what other information has been given? Land. Generally, in land, when it comes, you don't consider the revaluation here. Okay, you don't consider only in case of depreciable assets, you will consider the depreciation and provide. In case of any other assets, it's purely the book value you'll have to consider. So there are two information given with regard to land. Then it was revalued to 7.5. Don't ignore that. Consider only the land book value. Next comes debtors. This is also given directly. Okay, these are non-depreciable assets, just the book value. Now, depreciable assets, you have to definitely provide depreciation if they have missed out. So they have told in the question for furniture and patents, depreciation was not provided. So that you will have to provide. Okay. So under working note number 1, we need to do one more working note and another working note for the depreciation. So system, you can arrange your answer this way: note number 2, note number 3. For the depreciation workings, don't mentally calculate and write down. Show it clearly. So how do I do? Let's go step by step. So furniture, it was bought on 1/12/2020. So it was put to use for less than 180 days, less than 6 months period. So in that case, half the percentage of depreciation. Furniture generally carries 10% depreciation. Instead of calculating 10% on 5 lakhs, I calculate 10% into half of it, which is 5%, or 10 into 50%. So I get only 25,000. So the closing WDV is so much. Next, patents. Cost as on 1/12/2019. This is not 20, unlike furniture. This is 19, has been so much. Here also, this was in that particular year, less than 180 days only it has been used. So 25% depreciation rate for patents into 50% only. Then this is my WDV as on 1/4/2020. Now 20 to 21 full year, 100% depreciation. So this into 25% using WDV as on 1/4/2021 as 4,75,781. Now fit in these values here. Furniture has been so much, patents has been so much. So the total of my assets is so much. Less current liabilities. For unit 2, they have given bank loan for unit 1, 70% is so much. So the balance 30% is for unit 2. That's how we assume. Trade creditors, they've given 20% is for unit 2. Unsecured loans, they've given 30% is for unit 2. So just fit in these values, you'll get the total of current liabilities. Reduce it, you'll get the net worth of unit 2, which is what? What are we trying to find out through this net worth? This is the cost of the that is the cost of unit 2. So I know the sale value, net sale value, minus cost gives me my gain. Okay, so fit in this value here. So my gain, which is going to be taxed since it, and the gain and this unit being held for more than 36 months is a long-term capital gain to be taxed. Yes, Paka. Any doubts?
No,
Yes.
ma'am.
Very good.
No,
Super.
ma'am.
Yeah. So even if you've not learned, this particular concept should be clear to you. Okay. So if you know the provisions and do this, it will be much more easier. So we will hit upon 2 heads of income. Salary is over to do for us. Mr. Raju, a manufacturer at Chennai, gives you the following manufacturing, trading, P&L account for the year ended 31/3/2022. So this trading account, manufacturing account, opening stock, closing stock, sales, raw materials, manufacturing wages, gross profit. And continuing the P&L account, brought forward of the gross profit, dividends from domestic companies, income from agricultural, and on the expense I have administrative charges, SGST penalty, GST paid, general expenses, interest on bank, on machinery term loan, to depreciation, net profit. What other details are given? That administrative amount which you saw includes 46,000 paid as commission to the brother of the assessee. However, the generally commission amount which is liable, which is the prevailing commission amount in the market, prevailing market rate is only 36,000. Next information, he is paid so much, 33,000 to a transport carrier on 29/12. This amount is included where it should be, so if it is administrative, we know administrative item we saw in the P&L. But transportation related payment, we've not seen a separate heading, but that's why they have given it is included. If you see in the trading account, this amount is included in the manufacturing expenses. Assume the provisions relating to TDS are not applicable. Next, salary 4,000 per month to a staff throughout the year, and this has not been recorded in the books of account. A sum of rupees 4,000 per month has been paid to a staff. Probably if you have made any cash payment, you've not just put into your books and all. Okay, if it has gone through bank, it would have definitely hit upon. But since it was a cash payment, we assume it is not accounted. Bank term loan interest actually paid up to 31/3/2022 was 20,000, and the balance was paid in November 22. So some amount is there as right. We saw in the P&L, bank loan interest. There they are providing you an information saying up to whatever was paid up to 31/3/2022, that is the close of the year, is 20,000 only. However, the balance has not been paid. But when you're when you're noting in the P&L account, you will definitely note down the entire interest loan amount only. That is, which you should have paid due, right? Whether paid or not is different, but what is due and what you're required to be paid, what is required to be paid is what we will record in the P&L. Next, housing loan principal repaid during the year was rupees 50,000. And this relates to a residential property acquired by him in 2021. For self-occupation, interest on the same was 23,000, which was paid. This is not at all dealt with the profit and loss account given above. Depreciation allowable under the IT Act has to be computed. Is computed on the basis of the following information. So the WDV less depreciation for that year, additions during the year, total additions, and ignore any additional depreciation. So you have to ignore additional depreciation, just ignore those provisions. Compute the income chargeable to tax for Raju for AY assessment year 22-23, assuming he is not opted for 115 BAC. Okay, so assuming he doesn't opt for that, we need to find out. Ignore 14A disallowances of expenditure and so on. Yes, so how do we start for such a question? What is our starting point, people? Yes, what is our starting point in this question? Sorry. Yes. Oh my God, I shouldn't have showed. Yes, tell me. Generally, a question on profit and gains from business or profession will start from the net profit, what is reported in the P&L given to you in the question. That is our starting point. So that P&L is already adjusted in our workings. Okay, so starting point is the P&L given. This P&L is already worked out. Okay, if you want, I'll go back to the question. This 5 lakhs is already the arrived P&L as per your question. But whatever is wrong, we will either reduce it or add it. What type of details we will add to this P&L? Anything which is, when any expenses which has been omitted, we will add. Because since you have omitted that expense, or since you have calculated at a lesser amount, your P&L is high. Okay, your P&L is, if assuming I have not accounted for rent that I paid, rent is 10,000. Without ignoring that, my P&L has been, my profit has been 1 lakh. If I had accounted for that rent of 10,000, my profit would have been, the actual profit should be definitely lowered, right? So 90,000 would have been my actual profit. So any amount, any expense which I have omitted to be accounted in my P&L, that I will have to reduce. Okay. And anything which I have stated extra over and above the actual expenditure. My rent has been only 5,000, but I've showed it in the P&L as 10,000. So this is extra expense which I have shown. So any over expenditure has to be added back. Any under expenditure or any less expenditure or zero expenditure not recorded at all needs to be reduced. Any excess expenditure needs to be added back. Then only my profit will show the correct amount. This concept, is it all, are you all aware and clear about it? Only then you can work out a problem under profits and gains from business or profession. Yes, this is the basic concept under this. Yes, is it all clear, students?
Yes, ma'am.
Yeah. Now all the excess expenditure wrong, which is noted in extra, which is wrong, or which has not been, which should be disallowed, everything needs to be added now. So this commission paid to brother, we saw that commission amount which was reflecting was actually paid to the brother of Mr. Raju. Whereas, okay, it can be paid to a relative, not a problem, but which is in excess than the fair market value, that has to be disallowed. Okay, payment to relative, excess of the fair market value 48.2 will be disallowed. So 36,000, 46,000 he had actually paid, but the market value is only 36,000. So this 10,000, add back. When you add, your profit will increase, right? You wanted to show a lesser profit, so you showed pay to brother as 46,000. No, you will have to increase your profit. This is extra, so add. Okay, the logic is clear. If not, let me know.
Clear, ma'am.
Yes, yeah, the logic. If you know the logic, you will easily be able to know. You don't have to mug. Disallowed means add. Not accounted means less. You need not mug this. If you know the logic, it is easy. Now, payment to a transporter requires TDS. I mean, has a limit. TDS has to be ignored here. But payment to a transporter in a single day to a single transporter cannot be made in excess of 35,000 by way of cash. Generally, cash limit is very less, but only to a transporter you can pay up to 35,000. But here in our question, since he has paid only 33,000, which is well within the limit under 48(3), cash payment in a day, in a single day to a single person. So no disallowances. Nothing is disallowed. It is rightly accounted. Ignore. It's already there in the manufacturing expenses accounted. So now extra additions to be done here. No adjustments. Now we just assume, take it in a simple way, that cash salary, which I said is being ignored. One payment to a staff of 4,000 per month into 12 months has totally not been recorded at all, which cannot be. All business related expenditure needs to be accounted. So you've tried to escape that payment. Maybe we are assuming it's in the nature of unexplained expenditure. Okay, so unexplained expenditure means it will become a deemed income under section 69C. So no deduction is allowable. So in the case if the auditor finds you tried to show some you try to make some expenditure and you've not given an information about it, so he will consider that as a disallowance to the extent of 60%. I mean, this total amount will get disallowed and 60% will become taxable. So you cannot claim deduction about it. So you assume it this way. Also, on the other hand, you can assume it has been omitted and you can accordingly reduce it. Okay, depending, you just need to give a note with regard to that. Interest payment, very important. I told you, interest 60,000 recorded in the P&L, bank loan interest. But then there has been an information which stated 20,000 paid correctly before 31st March, no problem. Any interest on loan or such due payments under as per section 43B needs to be paid before the close of the financial year or before the due date of filing the return of income. What is the due date of filing the return of income? 31st October. Okay. But now when has been paid, November. Since it has been paid in November, this is beyond October period, you cannot claim a deduction. So bank loan interest amount may be 60,000. P&L is generally prepared on accrual or due based system, right? It is accruing in the year. Bank loan interest is so much, which I have to pay. Yes, account. It's not on payment base. We generally don't account on payment or receipt basis. We account on due or accrual basis. So due amount is 60,000. You accounted, okay. But did you pay? At least before the filing of return, 31st March books closes. I'm liable to file the return by 31st October, which I have 6 months period, 7 months period. By then, at least you should have paid your bank loan interest. Till that point of time, you have not paid. So this amount of 40,000 paid beyond October 31st gets disallowed. So 20,000 paid, okay, no problem, out of 60. Balance 40, disallowed. State GST penalty paid is disallowed. You assume. Okay, generally penalty for delay in filing, okay, allowed. But if there is a provision which you have contravened and so you are paying a penalty, that kind of penalty is disallowed. But depending, if you assume it to be a delayed payment penalty, you can give your assumption. So assuming it is a delayed payment, no adjustment I have made. But if you're going to disallow it, you need to give the proper assumption. And definitely depreciation shown in the accounts is to be debited. That is as per company's law, it has been provided, which needs to be disallowed. And what is allowed? The depreciation as per Income Tax Act is only allowed. So under the less item, actual depreciation as per income tax, which you will be showing it, which I'll show you the workings, is allowed. And on the income side, in a business, when I'm doing computation of profits and gains from business or profession, how can I take dividend? How can I take agricultural income? Are these my business income? Or yes, dividend is falling under which head of income, people? Income from other sources. It's not a PGBP item. Agricultural income, that is an exempted income. Though I've earned income, it is exempted under section 10(1). So that both these things, remove it. My 5 lakhs net profit is also because of these two head type of income. So remove it from your 5 lakhs, less the actual depreciation to be allowed as per IT Act. You will get the PGBP from business. Okay, so let's see the income tax workings, depreciation workings, and then I'll move to the next part. So depreciation, the value is given as 14 lakhs opening, less the depreciation for the year. Okay, that is my opening WDV. Now, new assets have been purchased, add that. So assuming the new assets is 2 lakhs, out of 4 lakhs, 2 lakhs is the additional asset which has been used for more than 180 days, plus the WDV minus opening depreciation value. So that into 15% is the block rate. Now 2 lakhs is worth assets used for less than 180 days into 50% of 15%. So that is 7.5%, which I get as 2,23,000. So this amount is only inserted here. So income from, the question is asked, the total income of Mr. Raju and not only PGBP income. So what you just found out was one part of his income. The other income which he has is no salaries. Second is what? Income from house property. Yes. Since it is self-occupied, you don't earn any income. But then I get a deduction. Interest on housing loan, self-occupied means allowed. So 23,000 is only paid as interest. So it's a loss from house property. Other sources, yes, dividend is taxable now in the hands of the recipient. So dividend income is 15,000. This you removed from here and you're showing it separately under income from other sources. So out of 5 heads of income, he doesn't have salaries and capital gains. All 3 are computed here. Less deduction, principal payment of housing loan. Interest you accounted here. But then 50,000 is the same housing loan, the principal portion of that. Yes, interest portion is you're claiming as a deduction under house property. The principal portion you're claiming a deduction and claiming deduction under section 80C. So that less this, you get the total income of Raju as 3,26,500. Anybody not clear any part of the problem, you can let me know.
Ma'am, I have a doubt.
Yes, yeah.
Ma'am, the person in this question is engaged in manufacturing activities. So isn't he eligible for claiming additional depreciation?
That's what, since it is given in the question as ignore. If not, you can definitely have to do this. See in the question. Ignore the additional depreciation under section.
Okay, ma'am, I didn't read that.
Yeah. So if it is not given, you can do for the additions that which he made. Yeah, that was a very good point. You remembered it, but you'll have also read the question properly. Yes, very good. So yes, clear. Anybody else with any other doubt? No. No.
No, ma'am. It's clear.
Yes. We'll move to question number 4. We've covered all the heads of income. 3 questions. Heads of income has been covered. And these are the assumptions being made. I was telling you, right? For the salary not recorded. And the second assumption is on the penalty on GST. So penalty for delay payment is actually allowed. But for contravening any provisions of the Act, it is not a compensatory and not deductible. But you'll have to make your assumption clear. Okay. Since the question only said GST penalty and did not say for what GST, you assume it is not compensatory and therefore not allowed, not deductible. Okay. If you have assumed it the other way, your total income will differ. It will be around 5,000 is. Yes. Now, what is the next head income chapter that we are hitting upon? Resident has provided the following particulars of income. So this is the partial integration taxation. Okay, so this person has agricultural income and he's also earning other income from salary, house property, and so on. So assuming he's of two different ages, what is his tax liability? So you need to know the income tax rates for calculating this. So partial integration method. So 115 BAC provisions need to be ignored. There's different slabs in computation, no? That you assume he's in the normal provisions. So tax liability, assuming for the first question 45 years. So for the purpose of partial integration, Mr. X has satisfied both the conditions. That is partial integration. What are the two conditions? Agricultural income plus non-agricultural income should be there, and your net agricultural income, that is after providing for expenses, has exceeded 5,000. So if it is less than 5,000, this will not be applicable. If it is more than 5,000, yes, you can go ahead with this. And one more condition is the non-agricultural income, other than the agricultural one, should exceed the basic exemption limit, which is set by the IP Act. What is the basic exemption limit? 2,50,000. It should be more than 2,50,000. So if these conditions are satisfied, I can go ahead with income tax calculation under partial integration method. So you all remember the steps for partial integration? Okay, so first we'll find out what is his total income, because he's having 2-3 heads of income. Salary, he has earned 2,80,000 given in the question. Income from house property, 2,50,000 given in the question. Agricultural income given as 4,80,000. If you want, I'll just show you the question. This is given. Agricultural income 4,80,000 given minus expenses. The net is 480 minus 170. That's all there in the question. Okay. So 310 totally exempted under section 10(1). So the gross total income is only 5,30,000. No deduction details are given under 6A. So total income is 530. Okay, now we'll find this is 5,30,000 is the non-agricultural income. What is his agricultural income? What's his agricultural income, students? 480 minus 170, 310. Right? So 310 is his agricultural income. So as per partial integration method, you will have to, the first step is NAI plus AI. What is NAI? Non-agricultural income plus agricultural income. Find out total. On that, calculate income tax. You know the slabs for income tax calculation. So 530 is my NAI, non-agricultural income, which you just found out. AI, you know, given in the question, net agricultural income, 8,40,000. How do I do the slab calculation? Up to 2,50,000, nothing taxable. 2,50,000 to 5 lakhs, this extra 2,50,000 on that 5% taxable. From 5 lakhs to 10 lakhs, 20% taxable. So since my income is well within 8,40,000, I restrict myself here. So 840 minus 5 lakhs, which is 3,40,000 into 20%. And then on the first slab, it is 5% on 250, which I get about 80,500. First step over. NAI plus AI. Yes. Next step, my AI agricultural income plus the basic exemption limit. Agricultural income I have, plus just if I had the basic exemption amount, what is the tax on that? So 2,50,000 for a 45 years old guy, 2,50,000 is his basic limit. So 310 plus 250, this is what I get. 5,60,000, calculate the same slabs. assuming if the total income is 560, up to 250 nothing, 255 5%, above 5 to 560 20%. I get 24,500. That is step 2. Step 3, the tax I found on the first step and the tax I found on the next step reduce, I get the step 3 amount, which is 56,000. Now the step 4 is on this balance tax, what I found out, the two taxes arrived at 2 different steps. On that, calculate 4% cess. No, that is how you generally calculate tax, right? The tax amount plus cess, health and education cess. So 4% on that. This is the total tax for this person, assuming he is of 46 years old. Now the next part of the question is, assuming if he's 70 years old, same steps, no change in the step, but what changes? The slab rates changes. So NAI plus AI. Yes, and this needs to be remembered. My net agricultural income is more than 5,000. Non-agricultural income should be definitely more than 3 lakhs. But what is my non-agricultural income? 5,30,000. So even if he's 70 years, 40 years, he's satisfying both these conditions. So I can go ahead with partial integration method. So 5,30,000 non-agricultural income plus agricultural income 840, the same amount, but the tax amount differs because the slab rate differs. So up to 3 lakhs for him not taxable, 3 lakhs to 5 lakhs on this 2 lakhs 5% taxable, and anything above 5 lakhs to 10 lakhs 20% taxable. Okay. Step 2, agricultural income plus the basic exemption limit. AI, that was NAI plus AI. Now it is AI plus BE. What is BE? Basic exemption limit. For 70-year-old person, 3 lakhs is the basic limit. So on this, find out the tax as per the slab rates. You get 32,000. Step 3 is step 1 minus step 2. And step 4 is on the step 3 amount plus 4%, the total tax payable by the 70-year-old person. I think we are running short of time. I'll quickly finish the last question. This is an SEZ unit. Okay, a person has an SEZ unit and one more unit as it is at the DTA. Are you aware of this concept? Which chapter is it hitting upon? Yes, who can tell me? Which chapter is this student? Exempted income, right? You all know the provisions, what are the kinds of incomes that are exempted? So yes, this Rudra has one in a special economic zone. So special economic zone, well within the same country, but it is due to its prominence in place, it is considered as a SEZ unit. And one other than an SEZ unit, we say it as a DTA unit, domestic tariff area. Now, these details are provided to him. Rudra as a whole is earning total sales so much, export sales so much, and net profit so much. But however, only the DTA unit is earning so much. So out of this big figure, this is a whole figure. This is a sub figure. So this minus this will give you what? SEZ figures. Okay. The total sales is 6 lakhs, but only the DTA portion is 6 crores. But only the DTA portion sales is 2 crores, means the balance 4 is pertaining to the SEZ unit. 460 is for the whole. 160 is for DTA, means the balance is for SEZ. That is the missing figure which you will have to apply your logic and find out. Now calculate an SEZ unit is eligible for deduction under section 10A of the Act. Now find out in the two different situations, what if the unit was started in the year 2014 May, or what if the units were started in the year 2018 May? Okay, just 4 years difference, but it makes a lot of difference. We'll see what is that thing. Now, and any unit set up in an SEZ, which is engaged in manufacturing or producing any article or even any services, not just production, even services during the previous year, prior to 1/4/2006, but before, not after 1/4/2006, but prior to 1/4/2021, is eligible for 100%, whatever the profit that is earned in that SEZ unit. Okay, SEZ unit, 100% is eligible for exemption, deduction for a period of 5 years. 5 consecutive assessment years. And it is eligible for 50% of whatever it has earned for the next 5 assessment years. Okay, now we'll see what is the profit it has earned. Then only we will know whether what is 100% and 50%. So in our first case, we are assuming it was startup, which year it was started in the year 2014. So 2014 to 22, right? It is definitely a 8 years period. So only for the first 5 years, it is 100% deduction. Okay, so 14 and up to now, if you see, it is more than 5 years, so you don't get 100% deduction. We have exceeded the first 5 years slab. Yes, are you all able to get the point here?
Yes, ma'am.
Yeah, so now we'll calculate the profits that it is eligible, that it has earned in the SEZ unit alone is eligible for this deduction. How do I calculate the profits? So the total export, see this profit, what we don't know the profit that it has earned in SEZ. So we can just purely find out using the cross multiplication. You know, from the figures given in the table, the third column was missing. That's what we said. This minus that will give you the SEZ related figures. So the profits of the entire unit was given to you. Profits of DTA was given to you. So that minus this will give you 60 lakhs. Same way, entire export turnover of SEZ is 300 lakhs. The total turnover is 400 lakhs. We are just, what we are doing is, if the total turnover of this company is so much, it has earned a profit of so much. Now we need to find out what is the profit pertaining to the SEZ unit alone. Okay, so I'll just show you the table again if you're not aware. So 6 minus 2 is the total SEZ profit. So 600 lakhs minus 200 lakhs, yeah, will give me the sales of SEZ unit. Total export sales minus sales of DTA is so much, will give me SEZ sales. Net profit 80 lakhs minus DTA net profit is 20, will give me my 40 lakhs profit of SEZ. Okay, so this is how it is used, substituted here. So profits of SEZ into the export turnover of the unit in the SEZ divided by the total turnover, I'll get a value which is 45 lakhs probably. That 45 lakhs, since it was started in 2014, I'm eligible to get only 50% of the reduction. I'm following the second block. First 5 years are over. I'm in the next 5 years period. So 50% of this, I'm eligible to get 22.5 lakhs as my exempted. Next, if the unit was set up in 2018, definitely I'm in the first block, well within the first 5 years. It shall be eligible for 100% of the profits which it has earned, and it can get exemptions under section 10AA. So here again, it is 60 lakhs of the unit in SEZ. So turnover, export turnover is so much, total turnover is so much into 100%. So the entire 45 lakhs. In the second case, assumption is exempted. Yes. However, for the DTA unit which is set up, no deduction under section. Only the SEZ unit is eligible for deduction in both the cases. DTA unit has to pay tax. Okay, this is what the working is. 600 minus 200, 460 minus 160, 80 minus 20. This is what you substituted. So the net profit of SEZ into the export sales divided by the total sales. Yes. So if the total sales has been 400 in the SEZ unit, it has earned a profit of 60. And in that same SEZ unit, if the export sales has only been 300, what is the relevant portion of that? In an SEZ unit, you will also make export sales and local sales. So you're going to find out only the profit pertaining to the export sales. So that's what you use the cross multiplication formula. 400 total sales, 60 is my total profit. What is the export profit for this 300? Use the cross multiplication formula and relevantly 100% or 50% deduction you can claim. Is it clear, everybody?
Yes, ma'am.
Any doubts?
No, ma'am.
Yeah, so today we've covered the heads of income plus exempted income also. Okay, so you may be aware at what stage you are in and what revision needs to be taken from your end. So definitely go through the provisions and quickly these provisions especially so that it will be registered in your mind forever. Yeah, thank you.